Welcome everyone to another video where you learn about the norm. I'm Coach Orlan and this is the first out of a two-part series for our topic, receivables. We will first talk about the definition of receivables as well as some of their examples. Then we will proceed with their initial measurement, presentation, and accounting for trade and cash discount. Let's get right into it. Receivables are assets that represents a contractual right to receive cash from another party in the future. So this can fall under a trade receivable or a non-trade receivable. Trade receivables arises from our usual or operations. This means that they will be regarded as a current asset if they are collectible within one operating cycle or 1 year, whichever is longer. For non-trade receivables, this will only be considered as current assets if they are collectible within 1 year. There are several kinds and types of receivables. The most common one is definitely accounts receivable, wherein there's a sales transaction with the customer and we have not immediately received cash from them. Therefore, our entity has an enforceable right in the future after a short period of time to demand payment from our customer. That is an accounts receivable. However, if the amount is considerable or the receivable is for a lengthy period of time, then a note is often prepared as a written proof. So this will now be called as a notes receivable. For loans that are extended by our financial institutions we have not yet received but we have applied for, these are regarded as loans receivable. Receivables can also rise up from our advances when we give advances to our employees, to our managers, and even to our suppliers. But these are often settled not by receiving cash but by rendering, for employees, by rendering their service, for suppliers, by delivering their inventory. Receivables can also rise up from our deposits. For example, when we borrow containers from a certain company, then we will initially deposit a cash as a promise or assurance that we will return their containers after a period of time. Once we return their containers, then we will refund the cash that we have deposited. That is another example for receivables. Receivables, whether trade or non-trade receivables, are presented as one line item in our balance sheet as trade and other receivables. The breakdown of these receivables are then presented in the notes of the financial statements. However, if there is any credit balance for accounts receivable, these are not offsetted against the debit balances of accounts receivables. Instead, the credit balance for AR will be presented separately as a current liability, commonly advances from customers, where the customer pays us in advance for a future delivery of inventory or provision of service. However, the other side of the coin also applies. If there is any debit balance for accounts payable, this will not be offsetted against the normal balances of AP. Rather, the debit balance of accounts payable will be presented separately as a receivable or a current asset, an example of which is an advances to suppliers. For the initial measurement, receivables are initially measured at fair value less transaction costs. For trade receivables specifically, this is often called the transaction price. Let's have an illustration to apply our knowledge. Information from the records of ABC Company is shown below. So we will compute for the total current receivables. Accounts receivable is for sure included. However, if you notice, there is a net of 10,000 credit balance there. So we deducted 10,000 to arrive at 40,000. We just mentioned a while ago that this should not be. Any credit balance of AR shall not be deducted from those with the positive balances. However, the 10,000 will be presented separately as a current liability. Therefore, we should add it back. As such, accounts receivable would be 50,000. Next, for advances to officers and employees, this is a non-trade receivable, and at the same time, since it is due in 22 months, it is not a current one. Next item is a notes trade receivable amounting to 15,000. Since this is a trade receivable, it is assumed that we will collect this within 1 year or 1 operating cycle, whichever is longer. Therefore, notes receivable is included and our total trade receivables would be 65,000. Let's continue. For non-trade notes receivable, only the part which is collectible next year will be included in our current receivable, and this represents the 3,000 pesos. For dividends receivable, this is a non-trade receivable and by default, they are payable within 1 year. Therefore, we will include the 800 balance. Lastly, for accounts payable, by default, this is a current liability. However, we mentioned a while ago that if there is any debit balance for accounts payable, these are not offsetted against the current liability. However, the 2,000 debit balance there will be presented as a receivable or a current asset. Therefore, that is included in our solution. The 2,000 debit balance will be regarded as an advances to supply. As such, our total current receivables for our illustration would be 70,800. Now let's talk about the accounting for trade and cash discounts. Trade discounts are given to our customers to encourage them to buy in large quantities and for us not to update our catalog every transaction. That would be impractical, of course. So typically, trade discounts are deducted from the list price in order to arrive at our invoice price. Take note that the invoice price is the recorded amount of gross accounts receivable. Cash discounts, on the other hand, is a conditional discount. This will only be given if the customer is able to make a prompt payment. Therefore, there is a discount period that is only limited, and if the customer pays within the discount period, a discount is provided. Under our generally accepted accounting principles, we can record our cash discounts under two methods, gross method or net method. For the date of sale, under the gross method, we will debit accounts receivable and credit sales. For the net method, we will use the same account titles. The difference is in the amount. For the gross method, both account titles will be at invoice price. Take note that it is already net of the trade discount. However, for net method, the invoice price is further deducted by the potential cash discount. Under GAAP, we don't really consider the probability of the availment of cash discount for now. If the accounts receivable is collected within the discount period, then we will debit cash, debit sales discount, and credit accounts receivable. The account receivable credit represents the invoice price. We deduct the cash sales discount, and that would be in our debit. As such, the net amount will be the amount debited to our cash. On the other hand, since we already recognize the potential cash discount in the date of sale, under the net method, we will just debit cash and credit accounts receivable. Again, for debiting cash and accounts receivable under the net method, it is already at invoice price less cash discount. However, if there is a collection beyond the discount period, under the gross method, it will not be necessary for us to debit a sales discount. It will just be a debit to cash and credit to accounts receivable for the gross amount or invoice price. While for the net method, we need to reverse the cash discount that was initially deducted from our sales during the date of sale. Therefore, the entry for the net method, if we collected beyond the discount period, would be a debit to cash, a credit to sales discount forfeited, and a credit to accounts receivable. The credit to sales discount forfeited represents an additional revenue. The debit to cash is at invoice price. We deduct the sales discount forfeited, and we will credit the accounts receivable. Therefore, the amount of accounts receivable that we will credit, whether it is within the discount period or beyond the discount period, under the net method, we will always credit accounts receivable amounting to the invoice price less cash discount. While for the gross method, the accounts receivable credit will always represent the invoice. Let's have an example. The entity sells inventory with a list price of 20,000 pesos on account under credit terms 10%, 20%, 2 over 10, and over 30. As of now, we ignore this probability. This is not considered under GAAP. We have observed that there is a set of discount here. There's the 10% and 20%, 2 over 10, and n over 30. The 10% and 20% is regarded as a trade discount. Remember that trade discount is deducted from our list price to arrive at our invoice price. This means that the sales transaction is recorded net, always net of trade discount. On the other hand, the 2 over 10 and out of 30 represents a potential cash discount. Therefore, the invoice price would be 20,000 multiplied by 100 minus 10%, 90%, 100 minus 20%, 80%. The invoice price would therefore be 14,400. On the other hand, 2 out of 10 and out of 30 represents cash discount. The cash discount is only given when the customer pays within 10 days. The company will provide a 2% discount if that happens. However, the account in itself is due within 30 days. Let's record under the date of sale. For gross method, we will debit accounts receivable and credit sales at invoice price 14,400. Again, that is net of our discount. So 20,000 multiplied by 90% multiplied by 80%. So I just presented the discount price there. While for the net method, we will debit and credit the same account titles, but take note that we have also considered the 2% cash discount possible. Therefore, we recognize a lower amount of 14,112, representing invoice price minus cash discount. If we are able to collect from the customer within discount period, then under the gross method, we will debit cash amounting to 14,112. Take note that this represents the invoice price minus the debit to the sales discount of 288 pesos. While for the net method, since we already took account of the potential cash discount in the date of sale, we will just debit and credit the following amounts at net of cash discount. On the other hand, if collection happens beyond discount period, there is no need to recognize and debit a sales discount under the gross method. So we will just debit cash and credit accounts receivable at invoice price. On the other hand, for the net method, we need to reverse the sales discount that was initially deducted from the date of sale. Therefore, the entry for the net method would be a debit to cash. Take note that the cash received is at invoice price, credit to accounts receivable at invoice price minus sales discount, and we will credit an additional revenue under the account title Sales Discount Forfeited for 288 pesos. Sales discount forfeited will be accounted for as additional revenue. Now, for IFRS 15, it is almost the same as a net method. However, there is a consideration regarding the probability of the discount that will be availed. Let's illustrate. Under the date of sale, the entry then under IFRS 15 revenues from customers would be a debit to accounts receivable and credit to sales, both at invoice price. Then we establish an allowance for sales discount. So a debit to sales discount and a credit to allowance for sales discount. For simplicity's sake, I just accounted the allowance for sales discount as a separate entry, but both are recognized under the date of sale. Take note for the allowance entry, that would be the invoice price multiplied by the cash discount rate multiplied by the probability that the discount will be availed. If there is a collection within discount period, under the gross method, if you remember, we debited a sales discount. By the way, the sales discount is a contra sales account. This means that the debiting of sales discount will lead to a reduction from our revenue. But for this, a debit to allowance for sales discount will be recognized instead. And the cash, again, is net of cash discount, but the debit to allowance for sales discount represents the cash discount, and the accounts receivable represents the invoice price. Lastly, if the collection is beyond the discount period, then we will debit and credit the following amounts or accounts at an invoice price, while we will reverse the allowance for sales discount that we initially set up. Let's apply these entries to our example. Now, this time, we record the same example under IFRS. So, at the date of sale, we will debit accounts receivable and credit sales at invoice price. Also, at the date of sale, we will establish an allowance for sales discount. That would be 216. That is computed by multiplying invoice price multiplied by 2% cash discount. And it says here in the last sentence of our illustration, only 75% of the cash discount will be taken. That's the estimate. So we will also multiply 75% probability. Again, under US GAAP, we don't do the probability part. We don't take that into account. If 75%, as predicted, was collected within discount period, the entry would be a debit to cash, debit allowance for sales discount, and credit accounts receivable. Take note that the accounts receivable invoice price is 10,800. We multiply it by 98% to arrive at 10,584 debit to cash. The allowance for sales discount amount of 216 again represents 10,800 multiplied by 2%. However, if not the entire 75% estimate is collected, only 60% is collected within discount period, then the entry would be debit to cash, let's say 60% of 14,400, the invoice price is credited under the accounts receivable of 8,640, right? And then the 2% discount for that is 172.8. Once we deducted 8,640 minus 172.8, that will represent the cash collected for 8,467.2. Since we have recognized only 172.8 allowance out of 216, that's the only portion that materialized, we need to reverse the remaining amount of the sales discount and its corresponding allowance. Because we have not consumed The entire allowance for sales discount a while ago, we have established 216, but we only availed 172.8. We need to reverse the remaining allowance for sales discount. Therefore, we will debit allowance for sales discount and credit sales discount for the remaining amount of 43.2. Again, that is the difference between 216, initial allowance established, minus 172.8 sales discount taken. That concludes our first video for accounts receivable. If you learned from this video, please consider leaving a like and subscribing to our channel and ring the notification bell. See you in the next part of accounts receivable. Bye-bye!